Well, sticking with bank shares of PNC are falling this morning, down about 2.7% there. The regional bank posted lower earnings for the third quarter, blaming its weak results on low trading revenue, loan syndication, and merger and acquisition revenue. The company sees higher rates playing a big role in business investment and consumer spending to impact their bottom line going into mid-2024. For more on PNC earnings, I'm joined by Alexander Yokam, CFRA Research Senior Equity Research Analyst. Good to talk to you today. What was the one line here that stood out to you? Any real surprises in the results?
In terms of surprises, I wouldn't necessarily say that, but there was a little bit of weakness on the balance sheet. If you look at deposits and loans, both down. There's been a lot of talk about loan growth slowing, and PNC is heavy in commercial loans. So think like businesses, and businesses don't want loans right now. They're holding out hope that rates will fall, and it hasn't happened. So we saw some pretty weak loan balances, actually loan contraction for PNC. And then on the deposit side, there was some weakness there. And, there's been a story about rising funding costs. We've seen that continue. And for PNC, non-interest bearing deposits continued to run off, which is a concern just because, if you can get non-interest bearing deposits into loans, it's very profitable. So when you lose those, it tends to hurt.
Going back to loan balances, they're certainly a good pulse when you look at these numbers, given that it is the second largest regional bank. I mean, what does that tell you about a further slowdown in the current quarter, given how quickly credit is tightening right now?
Yeah, honestly, there's been a slowdown for pretty much every category outside of credit card. Now for PNC, also some slowdown there, but in general, across the industry, credit card has still been strong. But yeah, I mean, with rates higher, we've definitely seen a big uptick, on higher yield. At the higher end of the yield curve, not today or the last few days, but over the last few weeks, definitely an increase there. So yeah, loan demand is down, and as long as rates are this high, we wouldn't expect, strong loan growth for banking in general over the next few quarters.
With regional banks, certainly commercial real estate in focus, given the exposure with so many. You've highlighted the fact that, this bank specifically doesn't have the kind of exposure to office space, which is the big concern here. What does that look like? I mean, there's been so many doom and gloom scenarios that have played out there. How is PNC positioned in the broader landscape when you consider the concerns around office space?
Yeah, so I would say the concerns over office are real. Office is struggling. Office will have large defaults, but you have to remember, most banks do not have large exposure to office, right? So PNC has 2.7% of all loans in office. So what we saw this quarter is there was a deterioration in office, there was a deterioration in commercial real estate, but net charge-offs actually declined at PNC, right? Because their portfolio is so large, so diverse, and the rest of the portfolio was actually performing well, they actually did okay. So it is really important to always look at, what percent of the portfolio is in office. And, for a bank like PNC, because the rest of the portfolio is well, they're reserving for really catastrophic scenarios, where office values fall 75%. They can do that when just a small percentage of their portfolio is struggling. If we start to see credit concerns in other categories, that's where there could be real concern. But for now, it's mostly still pretty strong.
We are, of course, several months removed from what we saw in terms of regional banks, the SVB collapse. Feels like things have stabilized a bit more. But when you look at across the board on regional banks, where are you seeing the biggest pain point, especially with these rates pushing even higher? And are we likely to see further consolidation?
Yeah, so pain points is definitely rising funding costs. So you'll see at the large banks, they have excess deposits. They really loaded up on deposits during the pandemic. So even though they're seeing outflows of deposits, it's relatively okay. For the regionals, they have less deposits. So when those run off, it hurts more. You see the net interest margins of these smaller banks really get hit. So that's an issue. Another issue is there's expectations of more regulation, following the collapse of Silicon Valley Bank. And there's expectations that some of these securities losses or unrealized losses are going to be required to be added to capital ratios, right? So Silicon Valley Bank, their capital ratios were strong, but if you looked at their securities, it would have made their capital ratios worse, right? So this is something that we're now looking at, across the industry for regional banks, and a lot of regional banks have pretty large unrealized losses, and that hasn't helped because long-term rates have been rising. So those largely increased in the third quarter. Again, not so much for PNC. They're very well, they have a strong history of managing risk, so they didn't really load up on these securities. But a lot of other regional banks did load up on these securities, so they're struggling there. In terms of M&A, it would be an attractive environment. A lot of these banks are trading at lower multiples, but most banks are being pretty cautious right now, right? They're trying to increase their capital ratios. They're not necessarily in offensive mode. Most banks are in defensive mode right now. So I wouldn't expect necessarily too much M&A this year.
Alexander Yokam, CFRA Research Senior Equity Research Analyst. Good to talk to you today. Appreciate the time.
Thank you.